Thank you. Good evening, everyone, and we welcome you on one of its kind offering of Prabhudas Lilladher, which is first of its quant-based portfolio management services offering. And we welcome all our valued investors, our progress partners, and my fellow colleagues. The flow of today's presentation is going to be, there will be an introduction speech by our joint MD, Ms. Amisha Vora, followed by a detailed presentation by me and my colleague Siddharth. During the conversation, if you all have any question, you can post your question in Q&A and we will definitely try and answer your queries. We are always approachable. So if you want to make it more interactive, if you want anything, we'll try to keep the flow in English or Hindi. क्योंकि वी हैव पैन इंडिया पार्टिसिपेशन, तो थोड़ा हिंदी में भी हम कोशिश करेंगे कि हम इन बिटवीन थोड़ा थोड़ा जो इम्पोर्टेंट कम्युनिकेशन है में समझाते रहे, ताकि आप लोगों को एक डिटेल अंडरस्टैंडिंग मिलती रहे। और कहाँ पे कोई भी क्वेरी या क्वेश्चन है, so please feel free to get in touch with us. And we are really thankful looking at such a large participation from every one of you. Really thanks a lot for this warm welcome, and I'll hand it over to Amisha for her opening remarks, and then probably followed by Siddharth and me. Thank you, everyone.
Thank you, Nupur. Welcome, everyone. Very, very happy to welcome you in this webinar. Namaste, Kem Cho, and I think if I pronounce it right, Vadakkam. Welcome, everyone. Let me tell you where the seed of this first of its kind product was sown. And let me also introduce you all to the team that is behind this product, which I'm sure in times to come will make all of you feel very proud about. So sometime in 2017-18, we formed this newly set up division called Quantify. So in the 75-year-old company that we are, this is our startup within. Why? Because we were trying to do with all these youngsters to whom I'm just going to introduce you all, something which is not done before in India. So the team is led by Siddharth, who's a master from Warwick in business excellence, and he is a CA and CFA, and he has still not completed his studies and desire for studies, so he is further studying also. He is joined by an economist called Ritika. He is joined by statistician called Raviraj. He is joined by Georgia Tech computer science student come now the professional called Rishabh, who's still in US. He's joined by a 6-member team who work on Python, R, machine learning, and of course .NET technology, who are the programmers. And he has his team of other CAs and CFAs and technical market analyst, which is a course from US. Now this young team, I think the average age of the team is 27 years, 20. Which is very unlikely to be a team who can manage funds. And this team, if they want to ask for your money or your client's money, their work, the depth of their understanding has to be so much more better that you can trust a part of your money or your client's money to this team. And as this is the opportunity for all of you to understand and take an opinion and a judgment as to whether our team has done a good justice in terms of their framework for investing, their methodology for investing, and their aim for investing for clients' money, and of course, beyond that, their execution to achieve the goal. I will also put 2 to 3 basic trends which are there in investing, very prevalent in developed world today. We all say, generally, while assessing any investments, पोर्टफोलियो मैनेजर कौन है, क्या स्टॉक लेने का, ये स्टॉक मल्टीबैगर होगा कि नहीं, सो ऑन एंड सो फोर्थ. ये पूरी जो स्टाइल है, ये स्टाइल को बोलते हैं एक्टिव मैनेजमेंट, जहां पर एक स्टॉक को समझने का, उसका फ्यूचर समझने का, उसका फ्यूचर ये मैनेजमेंट केपेबल है कि नहीं एग्जीक्यूट करने के लिए वो समझने का, और उसके ऊपर ये भी समझने का कि प्राइस ठीक है कि नहीं. ये पूरी गैमेट ऑफ डिसीजन मेकिंग को बोलते हैं एक्टिव फंड्स मैनेजमेंट. अब ग्लोबल ट्रेंड क्या हो रहा है, जैसे आपको एक वर्ड तो पक्का पता होगा, ETF, which is a way of passive funds management, where आप मैनेजमेंट पे, प्राइसिंग पे, बिजनेस आउटलुक पे लंबा कॉल नहीं लेते हैं. आप कॉल लेते हैं कि कौन से सेगमेंट या सेक्टर में जाना चाहिए, और बियॉन्ड दैट कोई और क्राइटेरिया पे लेते हैं, उसको बोलते हैं पैसिव मैनेजमेंट. ये जो पैसिव मैनेजमेंट इंडेक्स या ETF अभी लास्ट समझो कि 15 साल में वर्ल्ड का फ्रॉम अबाउट 25 to 28% has become 70% of total assets under management. This is the way in which the landscape has changed. So, in this landscape, क्यों ऐसा चेंज होगा वर्ल्ड ओवर? क्यों? इंडिविजुअल इन्वेस्टर, पेंशन फंड्स, कॉलेज रिटायरमेंट फंड्स, इंश्योरेंस फंड्स, जो लार्ज इन्वेस्टर्स हैं, क्यों पैसिव में पैसा डाल रहे हैं? ऐसा क्या उनको पैसिव में लग रहा है कि वो एक्टिव से पैसिव में जा रहे हैं? एक इंपॉर्टेंट बात ये हो रही थी, अगेन एंड अगेन it was happening that active fund managers were, as a majority, were not able to beat index, which means this year A fund beat index, but next year B fund beat index, third year C fund is beating index. So how as an investor you will decide that, okay, first year I'll be my PMS fund manager will be A, next year will be B. So you have to be so precise, because 90% of the active managers were not able to beat the index. So you were taking so many chances. Despite giving your money to the professionals, markets have become so advanced and informed that beating the index became a challenge. On the top of it, beating the asset class also is one more layer. So to make a beginning in this, and with the intention that we do tactically active with the help of passive funds, we have come up with this new offering. And we will try, I know the chats I'm seeing, whether Hindi or English, and I will try my best to do. And I'm of course not going to take a long time. It will be over to Siddharth soon and his team. But to create the background, what I was trying to say is that this product is trying to address the growing segment in the market, which is about passive, but this is tactically passive. Last but not the least, why we say quantify? Why we say quant based? We say quant based because we are taking not only fundamentals, but a lot of other parameters or criteria to arrive at the decision making. So it's quant based, which of course will be explained at length. And before I conclude, I would like to say that the product is designed and implemented with clear two intentions. Number one, try and grow the invested capital at a time when the tide is in favor. Second, try and not lose the whole gain when the tide is not in favor, and go and sit tight, keep quiet, and protect the capital so that when once again the tide is in favor for that asset class, we are back in action. With this basic broad criteria for designing this product, I now invite Siddharth to take you all through this product in detail. Thank you, everyone.
Thank you so much for the lovely introduction of the product and the team. I think I'll need the screen share rights so that I'm able to share my presentation. So whoever is hosting it, please make me the panelist.
Now you'll be able to share, Siddharth. I've just stopped share, so I think. Yeah.
Okay, now it's
Perfect.
Yeah. Okay, so let's straight get into it. I'll try to speak in English, and I'll also in some areas try to give you the Hindi translation for the similar things. So our South Indian friends and North Indians and Gujaratis, everybody is comfortable with the whole flow. So firstly, the name itself conveys what the product is all about. It's multi-asset dynamic portfolio. So multi-asset means that we are not a long only equity product. We invest across different asset classes. Dynamic means that we are not a static portfolio with predefined weights. Our weights and asset allocation keeps changing. Quantify suggests that we are quant based. And because we are launching this under the PMS gamut, so as a SEBI registered PMS, discretionary PMS, obviously the minimum ticket size becomes 50 lakhs. And that is why the whole portfolio management approach comes in, where we take all the decisions, also execute everything. We do not leave anything to the clients or at their discretion. It's a pure discretionary PMS where the question, the answer, the decision, everything is taken by our team and the execution is also done by us. Now, to understand what the strategy is all about, we need to understand a few basic things. Firstly, what are the three pillars or what is the core philosophy of MADP? It's three things: protection, participation, and performance. So protection means when things do not look good and I do not feel that we can make superior returns in the markets, our first agenda is protect the capital. What is the risk of protecting the capital? We might miss some upside, but the capital is protected. When things look very good, the outlook is good, the valuations are good, the liquidity is good, the risk reward is great, that is when we want to participate aggressively. And that is why participation becomes the second tenet of our strategy. The third thing, performance. There is no way we can actively be consistent without a set of rules, without data backing every decision that we make. Consistency is only at best a hope. With a quantitative methodology, with a rules-based system, we are able to test our strategy not for 1 or 2 years, but for 16 years. which means that I have proof of what this model has performed like in the past and what could be the broad performance in the future. While future performance will obviously differ because the regime also changes, but there is more guarantee, there is more different from the traditional products that are currently offered. So the first one, as I already explained, we invest across 7 asset classes. I will tell you guys which are those 7 asset classes. Yes. So we invest across domestic equities, international equities, gold, fixed income securities, and liquid funds. Within domestic equities, we do not just take exposure to Nifty 50, which is a large cap representation. We also take representation to mid caps because mid caps give us a very high beta when the economy is recovering or when the markets are recovering. I will show you all how mid caps have outperformed large caps in a recovery period. Other than that, we also have gold. Gold is used as an inflation hedge, also to protect portfolios when equities are not doing very well. Fixed income obviously gives us stability that is required in bad periods of equities or in a favorable interest rate regime. Fixed income tends to do really well. There are also certain regimes when neither fixed income or equities do well, specifically regimes of tapering. In such scenarios, liquid funds come to rescue. And lastly, we take exposure to international equities also. Firstly, we get geographical diversification. Secondly, we get exposure to dollar assets. Thirdly, we get currency diversification. And fourthly, we get exposure to some of the best, largest, fastest growing technology companies in the world. India as a market has exposure to all the traditional old economy stocks, whether it's the financials, the banks, the industrials, the consumer companies, or the healthcare companies. What we lack as a country as of today is exposure to high growth technology companies. And as an investor, you must have exposure to technology because technology is what is dynamically changing the world and disrupting most of the traditional industries. So with these 7 asset classes, you get exposure to a very diversified global basket of assets. All of them are carefully chosen. Each of them have a very significant role to play. And gold becomes important at some times, equities become important at some times, fixed income becomes important at some times. So idea is to always have the right asset at the right time in your portfolio. And we have designed the methodology to be able to do this across market cycles. Another thing to note here is we take exposure to all these asset classes purely via passive instruments, which means there is no stock or sector selection at all. We only take exposure to asset classes via indexed funds or indexed ETFs. This obviously has a lot of advantages, including lower cost, higher liquidity, lower selection risk, so on and so forth. Another thing to understand about indexed instruments is that they are market cap weighted, which means as an active fund manager, I might select being overweight in IT or consumer or pharma or banks or auto. But my theory might not actually work in reality and I may underperform. What happens in an indexed instrument is that whichever sector or stock does well, the weight of that sector or stock automatically goes up, resulting in index performance, index outperformance. So whether banks do well or metals do well, the index should do well overall if some of the sectors are contributing positively. And this is very important to understand. An example I use very frequently is the Yes Bank example. What we saw a couple of years ago was that Yes Bank was a part of Nifty. After the whole asset quality and management issue, we saw Yes Bank's price correct to 70–80%, but we did not see that kind of erosion in Nifty. So as an investor of Yes Bank, I'm at a huge risk of capital. But as an index or ETF investor, what does the index or ETF do? It simply rebalances Yes Bank with a much stronger HDFC Life. So the index manager will always make sure that the largest, strongest, and most liquid companies form a part of the index. And consistently over the years, the index in 2000 versus the index in 2020 is completely different. The stocks have changed. Only 12 stocks are common. But the index has gone from 2000 to 15,000 at a Nifty level. And obviously, it's now at 50,000 plus at the Sensex level. So the idea is, as an index investor, safety is of utmost importance, which it naturally provides you. Some other things that I would also like to take you all through is the difference between tactical asset allocation and strategic asset allocation. We try to capture that difference in, just give me a second. Yeah. So strategic asset allocation is static, unchanging, and based on a client's risk profile. Tactical asset allocation is focusing on risk and return, opportunities in the market. It is active in terms of rebalancing, and the focus is on an outcome, a defined outcome. What do we want to really try to say here? If a particular client comes to you with a certain mandate, a certain age, a certain liquidity requirement, and a certain income profile, you design or customize an asset allocation matrix for the client. While that might be suitable for him, it is not the most opportunistic set of asset allocation. A tactical asset allocation, on the other hand, is the most opportunistic and risk-controlled asset allocation mix at any given point of time that keeps evolving as the market evolves, as the economy evolves, as the global monetary regime evolves. And that is why we have a one-size-fits-all tactical asset allocation approach, where if we are able to control risk across the portfolio, enhance returns across the portfolio, then clients of all shape and size should benefit from that. Now, another important thing to consider is the importance of asset allocation in the overall frame of things. So, in India, we usually believe that security selection, which is, picking the right stocks and holding the right stocks, is the most important thing because of the ongoing equity cult since the last 2 or 3 decades. Global markets are, of course, much more evolved in terms of understanding the realities and the nuances of equity markets. So equity selection, stock selection contributes merely 4.5% to returns. This is a return attribution study which is used globally. This is published by a university in their PhD department. So what this is trying to tell us is close to 91.5% of the returns are generated by which decision? It is generated by the decision of asset allocation, which means if I'm in the right asset at the right time, 91% of my work is done. Security selection only contributes 4.5%, and market timing contributes even lesser at 1.8%. To give you an example of this, during the whole COVID correction, even if I was holding the best stocks in India, say Bajaj Finance or HDFC Bank, everybody knows Bajaj Finance went down from 4,800 to 1,800. HDFC Bank also corrected more than 50%. So is my stock selection wrong or is my asset allocation wrong? Clearly, it's the asset allocation that has gone wrong, and I have been in the wrong asset at the wrong time, and therefore my portfolio is bleeding. So how do we prevent such things? By mandate, an equity manager cannot do this. They cannot invest in bonds, in liquid, in international securities, or in gold, because he has to only buy stocks by mandate. But as a multi-asset fund, the flexibility that we have is much more high. And for those reasons, we can perform across market cycles. Now I will take you all through this whole performance across market cycles so I can prove it with numbers. The first column here is the performance of quantify MADP. The next columns are representing different asset classes via their ETF instruments. The ETF instruments can be assumed to track the index extremely closely with a 1% variation at most. So let's look at a couple of important years and how the different asset classes have performed. So let's take the whole 2007, 8 and 9, a critical period in the history of equity markets. Let's analyze this period first. So in 2007, Nifty Bs, which represents India large cap Nifty 50 index, gave you a return of 53 odd percent. Mid caps gave you a return of 77 odd percent, which can be seen here. Small cap gave you a return of 94%. So this was an extremely good year for domestic equities. In a year like this, MADP gave you a return of 33.5%. So one might assume that there is some underperformance. Now let's come to 2008. In 2008, a Nifty is giving you a return of 52% negative, wiping off all of the gains of 2007. Mid caps are giving you 60% negative, wiping off all the gains of most of the gains of 2007. Similarly with small cap. Now, as an investor who started his investment in 2007, he would at best be zero, at a 0% return. But imagine somebody who started his account in 2008. A 100 rupee portfolio would become 42 rupees. So he's lost 60% of his capital. That's a very, very risky scenario. Now let's evaluate 2009. MADP is at 75%. Large cap is at 74%. Mid cap is at 99%. And small cap is at 113%. This again proves a very important point that in a recovery cycle of economy and markets, mid and small caps tend to outperform large caps. Similarly, in a falling market, mid and small caps tend to hugely underperform large caps. And for this reason, we have both large and mid caps in our portfolio, and we use them to our advantage. When we want to increase the beta or aggressiveness of the portfolio, we take exposure to mid caps. When we want to reduce the beta or aggressiveness of our portfolio and want to make it defensive, we try to park money in large caps, in S&P 500, in gold, in government securities, etc. Now, at the end of 3 years, we are at a 55 and 75, almost 140 kind of 130, 140% return in MADP versus almost half of that in equities. So at the end of a 3-year cycle, you're much better off staying diversified rather than being concentrated in any single asset class. This was an important area of the markets to study. Let's study some other time periods. This was a very good period for MADP. Now let's see what is the worst performance of MADP. That has been in year 2015. This is a year where large cap equities have given you negative 4% return. Gold has also given you negative 8% return. Most of the other asset classes have given you in your below the 10% mark. In such a year where two of my prime anchor assets, which is large cap equity and gold, have tremendously underperformed, we have still closed the year with a 1% positive, 0.8% positive, which means that even when things go wrong, we are able to protect your capital. And when things go right, of course, we are able to participate and grow your capital systematically. Let us look at 2017 and 2018 once again. 2018 in particular, mid caps were down 15% for the year. Small caps were down 27-28% for the year. Large caps were up 4.5% for the year. Even in such a scenario, we could give you a 13.6% return for the year as seen here in the 2018 row. Now coming to 2020, again a landmark year for our strategy. We have closed the year, calendar year, at 55%. From January 1st to 31st December 2020, we have closed the year at 55%. Now when we look at Nifty, it is only showing 15.8%. Why so? Even though we've had one of the best bull markets in the post-COVID era. Obviously, we started the year at anywhere above 12,000, went down all the way to 7,500, and then ended the year close to the 14,500 mark. So as a percentage return for the year, we've still clocked just 15.8%. Even mid caps have clocked 25%, small caps also 25%. So how is it that we have clocked 55%? When the asset itself is not giving a return, how have we got more returns? The secret lies in tactical asset allocation. When we go ahead, I will show you the exact rebalance that has happened in the strategy. So around February 2020, we have moved out of equities. We've brought the exposure down from 75% to 18%. When we took this decision, what it does, every time the market falls, we don't have to go through that fall. And after the market is corrected, we have got equal amount of capital to redeploy at those lower rates. And this is the source of returns. The tactical allocation done by our proprietary quant models is the source of our alpha. And that is what everybody needs to understand. Overall, if we look at the entire period from 2007 till 2021, one can confidently see and clearly see that we have protected capital in bad years. We have participated aggressively in good years, and we have been in or above the median in normal years. So overall, as a strategy, we have been able to manage the client's capital very safely, very scientifically, and with a lot of stability. And that is the whole agenda for anybody who has lower risk appetite and lot of money to park. This product is absolutely suitable given that it can grow its capital without sacrificing the safety aspect. This is an important slide again that shows globally what are the trends in asset management. In 1998, 90%, close to 90% of the AUM was in actively managed funds. Only 11% was passive. As of 2019, this number has become 50-50 for active and passive. And as per the latest research, the passive has increased all the way up to 70%. So there is a clear trend where passive funds and passive strategies are gaining more popularity than actively managed funds. So where exactly does MADP stand? Within the whole gamut of active and passive, where do we stand? This slide is extremely important to understand the nature of our strategy. In terms of asset allocation style, we are active as represented by tactical or dynamic. So we fall here in the tactical asset allocation, which represents an element of active. In terms of investment security selection, we are passive, which means we do not buy any stocks in the portfolio. We only buy index funds and ETF. So our investment securities are passive. And what about our methodology? We are based on a quant methodology. So usually for an equity investor, we've heard of the Holy Trinity, which is quality, growth, and value. Quality business, growing industry and business, and valuable price to enter. Now in the new era of investing, what is the new Holy Trinity? This is the new Holy Trinity, where we have an index-based passive investment security selection, tactical asset allocation, blended with quantitative methods. When we do this, we are obviously eliminating our strategy of all security selection risk. We are eliminating all human biases because of the rule-based nature. At the same time, we are not dependent on a particular fund manager's style of investing, a particular fund manager's research methods, or a particular fund manager's bandwidth to assess data and analyze data and make decisions. So with a data-driven approach, we eliminate all of these biases and shortcomings of active fund management. So before we go into the methodology, I would like Nupurji to take you all through the returns of this strategy, which is very important to understand before we understand how we really do all of this.
Yes, thank you, Siddharth. And once again, welcome everyone. We'll try and थोड़ा कोशिश करेंगे थोड़ा हिंदी blend कर दे so that everyone understands for the better. See, friends, there could have been no day better than this for us to bring in these offerings. We market at 16,600. One of the most important questions that all of you have is more about preservation of wealth rather than growing the wealth, because most of the portfolios have given a very decent return in FY 2021. And even in FY21 till now, the wealth has really gone skyrocketed for the investors. This is a time when a product offering like multi-asset portfolio, which itself is dynamic in nature, which keeps shifting between the various asset classes. And as Siddharth has rightly explained that where do we take exposures? We take exposures into equities. And within the equities, we have a domestic and international for you. We take exposures to gold, bond, GSECs, so forth and so on. So, and going forward, probably many more to come. So in one product itself, you have lots and lots of varieties, de-risking your portfolios, and at the same time, helping you as an investor to generate a steady return. Coming to our main, which every investor who India में common saying है ना, मारुति का ad था, कितना देती है? That's where our slide comes for how much return one can expect out of his portfolio if he or she is an investor. See, for a consistent investment, we believe that one should have a minimum time horizon of 3+ years. Why? Because we are playing the cycles. And when you are playing the cycles, to get the cycle right, one needs to stay invested and get the maximum out of that particular cycle. So for all investors who have 3+ years of time horizon, conservatively, the strategy would deliver anything upwards of 20% very comfortably. No other asset classes or probably the various indices, if you see, have generated the return in upward of 15 or 16% CAGR, whereas this strategy has generated far better alpha. And it's not only about the return. Definitely the returns of multi-asset dynamic portfolio is far superior than the return of either Nifty or even for that matter, international funds like NASDAQ or S&P. Obviously, we cannot compare with bond or gold because they are considered to be either a safer havens or a hedge against your inflation. What is very important is keeping our standard deviation as lower than even gold. In gold, the standard deviation, investing in the gold, अब gold का 3-year standard deviation देखिए 14% है. जो हम generally समझते कि gold सबसे safe asset class है और लॉन्ग टर्म में गोल्ड इन्फ्लेशन से कहीं थोड़ा बहुत ज्यादा ही रिटर्न देके जाएगा. Our standard deviation is just 11.9. This makes you or one compelling to invest in such strategy जहां पे आपका स्टैंडर्ड डिविएशन एक इक्विटी से तो हाफ है. आपकी किसी भी इक्विटी आप निफ्टी का स्टैंडर्ड डिविएशन ले लीजिए तो 22 है. आप मिड कैप का ले लीजिए तो दैट इज अराउंड 20. नास्डैक हैज मच as high as 26. वो सबके कंपेयर में हमारा इन इक्विटी प्रोडक्ट के कंपेयर में तो आधा स्टैंडर्ड. दैट मींस यू शुड बी रेस्ट अश्योर्ड इन टर्म्स ऑफ the volatility that your portfolio can take. What is very important for one to know is about Sharpe ratio. See, as an investor, जब हम most of the time पैसा invest करते हैं तो हमारा सबसे पहला question या our dilemma is that if I'm investing 1 rupee, what is the probability of me making money if my thesis or my investment philosophy goes right. Here in best of the asset class, jahan pe I'm not comparing bond because as I already said that the bond is something which is always considered to be a safer haven. But if you compare the international equities or the domestic equities, whereas in most of the best among the international is Nasdaq, which is 0.91, our Sharpe ratio is 2.27. So in a bear market or a unfavorable market, we are protecting your wealth. In a good market, our probability is 3 times higher or better, I would rather say, than any other asset classes for you to make money. That is very, very important. At the same time, if you see with keeping your standard deviation low, keeping your Sharpe ratio very promising for individual investors to look this as a product, our CAGR returns are in upwards of 20%, which itself speaks about the robustness of my process. And as Siddhartha said, we have done a hard work of last 16 years of back testing this data. Since last 3 years, we have been testing our strategy live. So all these returns that you are seeing are genuinely generated over the period of time just by being in right asset at right time and allocating what is required to be allocated to that particular asset class. So if you have a good Sharpe ratio in upward of 2 to 2.25%, if you have a standard deviation of around 12%, and what better that you need with a return in upwards of 20%. So आपका risk moderate या कम है, आपकी probability काफी ज्यादा है, और आपकी return की consistency 20% के ऊपर है. So the conservative, at the same time the better way of managing your money. So if you have any question, you can post it in the chat box related to the returns. How we have done the alpha in terms of beating inflation. Generally हम कभी भी invest करते हैं तो हम यही देखते हैं कि what could be better or will I be able to beat the inflation. Look at the data since 2007 till 2020 of our year-on-year inflation. We have put the FD also because most of the investor looks upon FD as one of the most preferred investment, and then the multi. And when you see the returns of fixed deposit adjusting to inflation, it's negative. So अगर आप FD में long term पैसा डालते हो और आप उसको inflation के सामने adjust करते हो, तो आप पैसा बना नहीं रहे हो, actually आपका पैसा erode हो रहा है. And अगर आप multi asset dynamic portfolio को देखते हो against your inflation, then there is a consistency in the return that what we have provided to you as an investor. That is very, very important. So अगर आप you are an investor who wants a moderate risk तो हर investment में होता है. FD में भी risk है, हर एक asset में risk है. But अगर if you are looking as an investment which has a moderate risk, and you want to generate a better alpha in a favorable time, then this product not only helps you to beat your inflation consistently, but also gives you a superior return in terms of FDs and various asset classes, which have already been explained earlier. There's one question, I believe, in a chat box. If I could just take that, just give me 1 minute. It was just, how are the returns over 20-25 years period? And how are the returns like rate comparison? So we have done last 16. So our back testing is from 2006, end of 2006, and the calendar year 2007 say is active. So we have a 16 years of back testing data. So last 16 years of back testing data says that anything upwards of 20% is consistently that what we have got in our returns. Now, this is one, okay, this is one map which would help, yeah.
I'm thinking I'll take it for the methodology.
Sure. Perfect. So now what we'll do is that with such a superior return, obviously आप लोगों को ये जानना होगा कि ये return किस तरीके से हमने generate किया है और वो return generate करने के पीछे हमारा investment method क्या था. See, this is the heart of our product. There are certain proprietary meters, and Siddharth will take you through each and every meter. During the meters, if you have any questions, please post it. This is a very detailed work, And this will give you a confidence. Return to आपने देख लिया, return is, I would say, very mouth watering, and I'm sure that every one of you would like to immediately sign up. But what is a process with which we have generated this return is very, very important. So Siddharth, if you could take them through the return methods, please.
Sure. So this is by far the most important aspect of our strategy. Everybody should understand this in very, very clear details. I expect full attention on this one slide, because if you guys get a grip on this, it'll be extremely easy for you to understand the product, become comfortable and confident about investing in this strategy. At the same time, make your clients comfortable about investing in this strategy, because they will see the rigor, the depth, the granularity of our framework and how much time has been spent to build this unique strategy. So I will straight start explaining one by one. The idea is we want to understand cycles of asset classes. Within cycles of asset classes, we want to identify inflection points of these cycles. What does this mean? When something is going up, it is in an up cycle. After that, it stagnates, it's flat. After that, again, it can go up or it can go down. The go up or go down is the point of inflection. Every asset class has cycles. Within each of these cycles, they have these inflection points. We want to design a methodology to capture these inflection points across each of the asset classes. Point number one. Point number two is we want to always understand the risk reward at any given point of each of the asset classes. Now, how do we do this? There are so many variables that impact economy, that impact markets, that impact interest rates. We want to try to understand each of these variables, convert them into a model, get an output. The output should make a decision for us. That is the broad architecture. The first variable that we consider is the macrometer. Macrometer tracks the economic cycle. The economic cycle has huge implications over a medium to long term on equity markets. On the short term, yes, they do not converge, but over a medium to long term, economies and markets do converge. So macrometer uses 25 different indicators to understand the state of the economy. It not only gives us where we are currently, it also gives us the direction of the economy. I have given a short template here so that you all understand what the macrometer tells us. The macrometer shows us 5 phases: strong growth, steady growth, deceleration, slowdown, and recovery. These are the 5 economic regimes as interpreted by the macrometer. How do we arrive at these numbers? So we use a lot of alternative data modeling to arrive at where we currently are in the economic regime. For example, electricity generation, tractor sales, HCV sales, LCV sales, railway passenger traffic, 10-year GSEC bond yields, money supply, lumber and copper prices, coal production, railway freight revenue, two-wheeler sales, etc., etc. The idea is these indicators give us a sign into where the economy is heading. They serve to be as proxies for economy performance. And that is why the macrometer becomes a very important base for asset allocation. But is the macrometer alone enough to take this decision? Is it the only factor that affects equities, bonds, gold, etc.? No, there are many other factors. So we start looking at other factors. The second factor, the second important cycle, the monetary cycle. How do we capture the monetary cycle? We use something called monetary meter. Monetary meter helps us understand the interest rate regime, the global liquidity and money supply, and what is the bond yield and steepness of the yield curve. All of this helps us form a view on whether we should invest in fixed income securities or in equities or in a combination of these two. If we are selecting fixed income, should we invest in short duration bonds or in long duration bonds? If the interest rate is going up, short duration bonds tend to perform better. If the interest rate is going down, long duration bonds tend to perform better. The idea is how to select within government securities, which are 10-year securities, and corporate bonds and credit risk bonds, which are short-term securities. So the important thing to understand here is, if the interest rate regime is changing, can I adjust my interest rate in sync with these changes? If yes, the short duration will do better. If no, the long duration will do better. But when to select one of them is the whole idea. The next factor is the cyclometer. This tries to understand the equity market cycle. The equity market cycle can be interpreted in terms of valuation zones. We have 5 valuation zones. I'll take you through that right now. The 5 zones are highly overvalued or peak formation, overvalued, undervalued, deeply undervalued, and the yellow zone of fairly valued. The markets can be broken into these 5 zones. What becomes of concern is the red zone and the dark green zone, because we reach these zones very few times in extreme euphoria on the positive side or extreme fear on the negative side. As of now, we are in a peak formation zone, which means we are in a highly overvalued zone. And in the past, we've seen that this euphoria does not reverse in one day or 1 week. It tends to persist for some time before it reverses very sharply. If we go back to the 2006 and 2008 periods, we do see that yes, we continued to be in the peak formation zone for a sustained period of time, maybe a couple of months, before we reversed very, very aggressively. Similarly, over here also we see that we did tend to be in the red zone for some time before we reversed. Again, we are in this red zone. So when markets are at all-time high, what should be your investment strategy? To buy more stocks and more equities, or to reap the profits that have been made over the last 1 year and protect your capital base? If capital protection and timely participation is your strategy, that's exactly what multi-asset dynamic portfolio does for you. Now coming to the next meter, that is the short-term indicator to capture momentum or trend in asset classes. We use dual momentum, which means I want to capture absolute as well as relative momentum within asset classes to finally arrive at my outlook on that asset class. Momentum as an indicator is lagging in nature, and hence it is only used as a confirmation tool, which means I cannot rely on momentum to make my base asset allocation decision, but I can use momentum so that I get a confirmation that yes, the asset allocation mix that we have selected is being confirmed by the momentum meter also. So the momentum meter on its own has very high accuracy over a long term, as can be seen by the momentum portfolio of asset classes versus Nifty 50. A momentum portfolio that started at rupees 100 goes all the way up to rupees 3,500 because it only tracks momentum and trend in asset classes. Versus a Nifty 50 portfolio that started as at 100 has gone somewhere to the 750 levels. So idea is that momentum is a very important factor to capture over the different parts of the market cycle. Momentum helps us in understanding an upcycle, but also understanding a down cycle. When equities become last on the multi-asset momentum meter, it tells us that money is moving out of equities and the momentum is negative, and therefore it helps us protect in these zones. Now the next meter, which is again a variation of the momentum meter, it's called the gold meter. Here we try to capture the momentum in gold, at the same time its relative performance versus emerging market and developed market equities, along with comparison of gold to other commodities. We also evaluate the net long positions held by global investors in gold. This meter gets activated only in certain time zones, which means the output is dual. Either it tells us to invest in gold or it tells us to invest in other asset classes. When it tells us to invest in other asset classes, we do not take into consideration the reading of the gold meter. Only when it tells us to invest in gold do we start going significantly overweight on gold. That's the broad thesis of the gold meter. The next meter is the technometer. Technometer takes its inspiration from the broad technical analysis arena. The idea here is to capture technical risk and reward. So technical risk reward is what we want to understand here. How do we do that? So within the entire gamut of technical analysis, we have focused our entire study and modeling on two aspects: reversals and breakouts. Reversals try to capture a change in the primary or secondary trend. Breakouts try to capture a confirmation of the primary or secondary trend. This links back to the very first thing I told you guys, that we want to capture inflection points. Inflection points can be better captured using a technical framework also, which is why we use our technometer to give us confirmations whether the cycle is continuing or there could be a short-term reversal. This adds more depth and granularity to our model because economic cycles, monetary cycles tend to be medium to long-term in nature, but decisions have to be made on a short-term basis. And our short-term indicators help us be agile in our portfolio rebalance. The next meter is the centimeter. This is a proprietary tool that we have built, which tries to capture 25 different leading indicators of equity markets and quantify the sentiment in a number. Finally, that number tells us whether it is bullish or bearish. Is the bullishness increasing or reducing? Is the bearishness increasing or reducing? With the centimeter, we try to take tactical calls of moving out of equities much earlier than we can see in the markets. Again, the idea here is to have as many factors as possible to support our decision-making framework. So we are not over-reliant on one or two factors. None of these meters work on an isolated basis. They all work on an integrated basis. So this is a glimpse of technometer. The yellow zones show us areas where it is giving you a sell signal. There are fewer sell signals and more buy signals, but the idea is every time I need to move out of equities, those triggers should be fewer because over a 2-decade, 3-decade cycle, equity is in a bull market. It is those interim periods where we need to protect capital and reduce risk of the portfolio. Technometer helps us do that. So does centimeter. This is a chart of centimeter, and this also does exactly what the technometer does, but uses different parameters to do the same. If you see, the blue signal or blue is the dominant part of centimeter, which means most of the time it is telling us to be bullish. There are few areas when it is given us a bearish signal, and that is what we try to capture using the centimeter. The next meter is the global RORO or risk on risk off meter. The idea of this meter is to avoid any kind of global contagion. If the risk is purely domestic, it can be contained and we could see a 10, 12, 15% correction. But if the risk is global, then it is a very severe correction that can be experienced to the tune of 40, 50, 60%. So the global RORO helps us avoid these kind of global contagion corrections. We use 25 different global economies across emerging market and developed market to track the risk of a global contagion. We not only track emerging market and developed market equities, but we also track fixed income securities across developed and emerging markets. We also track commodities and metals across these markets. The idea is to see where is the money moving. Is the world going in a risk off mode, or is the world in a risk on mode? Again, we can see majority of the times we have been in a risk on mode, but then there are certain periods where we should be in a risk off mode. These are the times when we should be slightly more cautious, and that is what the global RORO helps us do. Another meter is the relative value meter. This helps us capture the relative value between large cap equity and small and mid cap equity. The idea here is, because we have mid caps in our portfolio, when to increase allocation to mid cap, when to reduce allocation to mid cap. This decision must be supported by data. To do this, we use the relative value meter. Again, its principle is similar to cyclometer, but it is specifically applicable for mid and small cap equities. This shows us zones when we have been deeply undervalued from a mid and small cap perspective, which tend to be excellent entry points for mid and small caps. It also shows us zones where we've been in the overvalued zone, which tend to be areas where we need to be cautious about our allocation to mid cap. As of now, we've got a signal to reduce our mid cap allocation, and we have seen a sharp correction in mid cap over the last 1 month. So with this, I've covered the broad methodology of multi-asset dynamic portfolio, where we use 9 meters to make asset allocation decisions. Each meters are supported by sub-indicators ranging between 5, 10 to 25 even. So on a total, we track more than 200 indicators to make the decision to allocate your money. This is why our model is granular and diversified. If it only tracked 1 or 2 indicators, it's not diversified. We are tracking multiple parameters, and that is why there is depth and granularity in the model. Another important point to understand is that we do not rebalance based on a particular time or a month or a week or a quarter. This is trigger-based rebalance, which is agile in nature. What does this mean? It's not that the investment committee meets once in a month or a quarter to decide if there should be a rebalance. The model runs every day. If it captures a trigger to change the asset allocation, it gives a notification for that. Once we get the notification to change asset allocation, we have to follow it. Events in market do not happen with a set calendar, which is the reason we cannot decide that once in a quarter we meet to review and rebalance. The model has to work every single day, and rebalance has to happen only if required. To support this point, over the last 16 years, we've had close to 42 rebalances, which means there have been some years where we've had 0 rebalances because the model does not see that there is a need to change. In some years, we've had 3 rebalances, and there have also been a certain periods where we have 6 rebalances. So idea is there is no fixed schedule for rebalancing. Rebalancing happens only if triggered by our models. So with this, we've explained you where we invest in, what is our methodology, how are we different, that we use passive instruments. I've explained you the different meters that go into the model. I've explained you the different scenarios of returns that could be possible, the risk that the strategy holds, at the same time, how we rebalance the portfolio. With this, I've covered a broad aspect of explaining the product. Now, if you have any questions, we would be happy to take questions at this stage.
Before we go, Siddharth, there's just one request. There's a request that they just wanted a technometer to be re-explained. So if you could just take 2 minutes and just in a brief, just take them, because there was one Q&A about re-understanding the technometer.
Sure. So technometer tries to use firstly price and volume data of domestic equities only, specifically index. Within that, we use 5 to 6 different proprietary rules, which it will be too technical to explain that. But idea is based on RSI, moving averages, MACD, Hull indicator, etc. We have arrived at a proprietary mix, which tells us when the technical signal is suggesting a reversal in a cycle on the upside or the downside. Based on the direction and the change, we give a signal from the technometer, simple signal, buy or sell. So we apply technometer not just on Nifty, we apply it on Nifty 50, we apply it on NASDAQ, on S&P, and on Nifty mid caps. So idea for technometer is simple. From a technical perspective, is the risk reward favorable or no? Has it captured a breakout or has it captured a reversal? That is the simple strategy behind technometer. I hope that covers your question. Anything else? So another thing I would like to share with you all is how tactical asset allocation is generating alpha and how we can prove that with numbers. So a benchmark represents a passive investment strategy of the same asset classes, which means I buy, hold, and do nothing. But a dynamic strategy, as represented by MADP, uses tactical allocation. So if we compare the returns of MADP versus benchmark, we understand what is the alpha generated due to technical rotation. In most of the years, we have seen that our tactical asset allocation is able to generate superior alpha barring 1 or 2 time periods, which means that the model's efficacy is very high. And that is what you all need to take away from this. We've already covered how we're superior on an inflation adjusted basis. So I guess, Nupur Bhai, I'm mostly done from my end if you want to add something.
Yeah, I think so. See, as we have already discussed and we've been emphasizing, this is the essence of this strategy is based on mainly 3 things. 1, protect your wealth. Second, participate. So protection is, so when this strategy was designed or when it was taken, though, the first primary aspect was to protect the wealth for everyone. Second, to participate. And most important aspect is that in a favorable market, you are in the right asset at the right time, so that you get benefited not only in terms of the superior returns, but also generating a far better alpha to that. So as Siddharth said, we are open for the questions. As it is, whenever I'm getting any questions, I'm answering them. But in case if you have any question, please post in Q&A so that we can do it.
So this, you can take them through this one, Nupur Bhai.
1 second, Siddharth, what was that you
Had
said?
we stayed invested in any of these strategies over 15 years?
Okay. So see, generally we always believe that investment is a long term, it's always done for the long term horizon. And one of the questions which was there in the chat box was about the returns. See, if you are a long term investor, so what we have done is that capital growth for last 15 years study, that what we did is that if you have been investing in a various kind of asset classes, or I would say indices, say NASDAQ or a mid cap or a large cap, or for that matter commodities like gold or corporate or bonds, corporate bonds or gilt funds, look at the kind of compounding return that you have got. Gilt funds just 3.2, corporate bonds only 3.7, gold not more than 5, it's less than 5, which is 4.3%. Large cap is around 5.5 times. Mid caps are 7.5, Nasdaq is hardly 15.7. what is very important that in last 15 years, the wealth is compounded in upwards of 25% with multi-asset dynamic portfolio. So this is purely based on our back-tested data since 2006 that what we have back-tested. But this is far, I would say, ahead or superior compared to. So when we are looking at, ultimately you guys would be interested that how my capital would grow, and consistency of capital is in 15 years it has grown by 25 times. So it's far more better than any other asset class what you can see, or any other indices where you can invest. Not even the large caps have generated the kind of return that multi-asset dynamic portfolio have generated. Nasdaq has done definitely better because there's been interest in technology stocks, and technology stocks have been doing slightly, or I would say far better. But with this kind of cycle, this is a kind of compounding, what we always call it as a power of compounding. In returns, it is very important for one to understand that what would be the power of compounding, and this is what is the power of compounding that multi-asset has.
Yeah, this is just showing, compared to all the different asset classes, the risk of so basically here we are trying to show you the return profile of MADP. This is the exact same representation of the risk profile of MADP. The black line represents MADP, and the other lines, for example, the gold line represents gold, and the blue lines represent equities. So from a risk perspective, a multi-asset approach has a much substantially lower risk compared to a single asset approach. And that's the broad thesis. So returns and risk. Anything else? Any questions?
There's one question related to the client will receive the return performance every month. So every month, so on monthly basis, as an investor, you will be provided with the live login or a web where you will be able to see your returns at the end of the day. Though this is not a daily product, PMS is not a product where the return should be monitored daily. However, at the end of every month, you will get a complete detailed report about the various asset classes where investments have been done. Along with that, you will also get your return performance for that particular month, how our portfolios have done vis-a-vis how the benchmarks have performed. And if required, once every quarter, we are always free to connect with us and understand that how our philosophy has been done. Okay, there are some who wanted to know about our costings also in this. Surely, in just few minutes, I'll explain it. But as it is, you are free to connect your distributor, or you are free to connect your advisors or a relationship manager. We have two kind of fee structure model. Okay, most of the questions are related to fee structure, so let me take it. Okay. So we have two kind of fee structure. One is a simple fee structure, which is 2.25% per annum. Every fees will be debited quarterly, which are fixed. So all fixed fees will be debited quarterly. So 2.25% will be divided into 4 equal quarters, and the bill will be generated. The second is hybrid model. Hybrid is a win-win for the portfolio manager and an investor, where your fixed commitment is very less. You are paying only 1.25% per annum. Then you have a hurdle rate, which is 10%. Over and above hurdle rate of 10%, you on an incremental profit. So any profit net of all expenses, if it is about 10% in calendar year or an anniversary year, then only on an incremental return you pay the 15% as a performance fee, which works with a high watermark principle. So year in which if your returns are superior, the next year you need to cross that by another 10%. And then only on an incremental return, you pay 15%. So these are the two kind of fee structure. Fixed fee are charged every quarter. this 2.25% is annualized, so it will get divided into 4 equal quarters. Similarly, 1.25% is annualized, which will get divided into 4 equal quarters. And performance fee is charged on an anniversary. So whenever any investor comes in, at end of 365th day, the performance fee calculation will happen at every year on an anniversary of that particular investors. So these are the two fee structure. I hope both are clear to you. Is any strategy assure the guarantee of the returns? Mr. Vikas, as per SEBI regulation, no product under equity or equity gamut can be rolled out or offered to an investor as a capital guarantee. So I'm extremely sorry, there are no capital guarantee. We cannot guarantee the capital because that is against the regulation. How to invest in minimum and maximum amount. Okay, so minimum amount for investment is 50 lakhs as per SEBI regulation. So no SEBI registered portfolio manager can accept initial investment less than 50 lakhs. But definitely post 50 lakhs, till your investment amount is over and above 50 lakhs, you can do a regular SIP, which could be monthly, quarterly, depending on what is the total investment that you are looking forward. Because we are investing only and only in ETFs and index funds, where the liquidities are very high, this can absorb any amount of investment. So even if you want to put at a single go 10 CR, this would can absorb because you are putting in one of the highly liquid, least impactable asset classes, which are either in ETFs or in index funds. Definitely, Mr. Vikas, we will definitely share. I'm just posting my email ID. So anyone who needs could just send me a message, and I will be able to help with that. And probably how can I track my so Vipul bhai, you wanted to know कि portfolio कैसे track कर सके? Just for tracking the portfolio, it is very simple. તમને વેબ લોગિન આપવામાં આવશે અને તમારા વેબ લોગિનમાં you will have all the information related to your portfolio, and same will be available with your relationship manager also. I have posted my email ID. Anyone who wants the hard copy of our presentation or any other questions, they can always send an email to me and I'll definitely revert. At the same time, you can also send an email to your progress partner or your relationship manager. They will also be able to provide you with whatever information that is required related to this product. Redemptions possible. Now, what is very, very important for this product, that when we designed, we were so confident after our 16 years of back tested data and 3 years of hard work, we have not kept any exit load in this product. Exit load is completely zero. Investors are free to come in anytime and free to go out of this product anytime. Now, whenever you want, you just send an email to us that you would like to redeem, and within 5 or 6 working days, we'll ensure that all redemption formalities are completed and you get your money back with zero exit load. So you are free to exit at any point of time. Any other questions?
Good. There is one question from Mr. Samir Godbole.
One second. Is model like swap in mutual fund possible here after a certain period? So if you could just elaborate swap in the sense that you want a systematic withdrawal you are asking about, or you are talking about this like, what is it, your precise question, like, if I could just understand? So, Samiri, what I can tell you is that keeping the minimum investments of 50 lakhs, which is a SEBI prescribed, you are free to top up or withdraw at any given point of time. So if you want, you can top up your account at any given point of time. At the same time, if you want, you can withdraw from your account at any given point of time, keeping the SEBI minimum requirement of 50 lakhs. I hope I have answered your question. Any other additional question? So there are no
So
questions.
there is one, Nupur,
Yeah.
one question from Mr. Hasid Thakur. Is the strategy using any derivatives of futures and options?
No, complete okay. So there are no derivatives, no futures. Our exposures are only and only via ETFs and index funds. That's all. And those 7 funds, as explained by Siddharth, not they will be the only funds where the exposures will be taken. So there is zero derivatives in this. No, we don't take any active exposures like stocks or derivatives. There are no sector risks, there are no stock specific risks, and at the same time, there are not going to be any derivatives. So SIP amount, okay, 1 second. Is SIP is definitely available. You can always ask for an auto debit from your bank account, and we can do that post the initial investment of 50 lakhs. The SIP is very, very possible. Is there any minimum or a maximum weightage to each asset class? Yes, there are. Siddharth, can we have the slide of where we have that asset class weightages?
That's I've not put it.
Okay, you could just explain them verbally till I take another question. Just go ahead.
There is a minimum and maximum. So for example, for Nifty, we use a minimum of 8%. For gold, also we have a minimum of 6%. Similarly, for NASDAQ, we have a minimum of 4%. Like that, every asset class, we have a min and max. But
I think Siddharth's audio has got stuck. And if Nupur, if you can take it over.
Yeah. So see, for every asset classes, there are. Siddharth got logged off.
sorry. So
Yeah,
I was
sure.
saying that there is a possibility of equities as an asset class totally going up to 80%. That's the max, which means across domestic large cap, mid cap, NASDAQ, S&P 500, across the whole gamut, we can go all the way up to 80%. But at a minimum, we should be at least having 15% in equities across large, mid, and NASDAQ. So those are the broad minimum bands. We also have an asset-wise minimum and maximum. So large cap, we do not reduce below 6%. Gold also, we do not reduce below 6%. Liquid also, we have minimum 3% at any given point of time. Like that, we have a min-max band for every asset class. I can share that with you offline separately.
So there's one more question related to the custodian, that why not directly with PL and why custodian? As per SEBI regulation, it is mandatory for all portfolio managers to appoint a custodian, and that regulation came in January 2020. So because of the SEBI regulation, all portfolio managers are required to have a custodian, and Prabhudas Lilladher have 2 custodians. One is HDFC Bank, and second, obvious, our most of the accounts are with HDFC Bank, which is one of the largest private sector bank in India and one of the robust. So I don't think so there would be any questions or doubts related to having a HDFC Bank as a custody for your securities. And for investors, it is more secure because it's a third party, which is an independent of any kind of volatility or the market reason. So for custodians, definitely I can take more questions, but we have HDFC, and it is one of the robust in terms of the custodian or the business, or they have the largest asset under management in India. There was one more question about SIP amount and lump sum amount. So lump sum amount as per SEBI regulation needs to be 50 lakhs. Post that SIP amount can be in multiple of 1 lakhs and thereon. Okay, for IT purpose, all investments. So as an investor, you will get a long-term, short-term capital gain tax statement from Prabhudas Lilladher, audited by our auditors at the year end. For all equity investments, so the amount of money that will be invested in equity PMS or an equity ETFs would definitely have those 10% and 15% for long-term and short-term, and the debt would have a debt implications. But as an investor, you will be provided with the detailed long-term, short-term capital gain tax statements applicable on equity and on debt. So that will help you and your chartered accountant to file, and at year end will provide audited profit and loss, balance sheet, and long-term, short-term capital gain tax statement. So you just need to incorporate those figures in your IT returns. I hope a custodian related question, then your tax calculation, what we can expect returns approximately. So as we have demonstrated in our past track record and our back testing, definitely no portfolio manager is allowed to give any commitment on the returns. But what we believe that conservatively, if one is having 5+ years of time horizon to invest, then anything in upwards of 18 to 20% should be a fair expectation of returns for everyone to invest in this. On which amount we charge annual fees? So annual fees are charged on the asset under management. So what will happen that as fees are charged, fixed management fees are charged quarterly. What is the amount, average balance of particular quarter? So say for example, Jan, Feb, March is one quarter. Then daily average balance of Jan, Feb, March, on that average balance in the month of April, the fees will be levied for Jan, Feb, March. So it will be on average balance for that particular quarter calculated on a daily basis. Our custodian is HDFC and Orbis both. Our preference is HDFC for most of our investors, and the accounts will be open with, so process, the documentation process is going on. So earlier when we started, it was Orbis, then we are moving from Orbis to HDFC. Our documentation for HDFCs are already on. For all new investors, we are preferring it with HDFC, and old investors, we are going to move from Orbis to HDFC soon. I hope I have not missed any questions, but in case if I have missed any, you all are requested to repost it. I'll wait for 2 minutes for anyone who wants to ask any questions before we end the session. Till we get additional questions, we request you to please connect with your relationship manager or a progress partner. You can also connect with us in case if you have any technical doubts. My email ID is nupurpatel@plindia.com. I'll once again repeat, it's Nupur, Patel, Patel @plindia.com. So if you want to write to me, you please feel free to write and we'll able to help you. Okay, what is TWRR basis? So TWRR is time weighted average return. Earlier, portfolio managers were allowed to calculate the return either on a CAGR basis or on model client portfolio basis. SEBI, as per the regulation in January 2020, have informed all portfolio manager to use a standard method, which is time weighted average return method. And all portfolio managers are supposed to provide the returns on aggregated on the strategy basis and not on the model client basis, and that too on a TWRR basis. Is there going to be a cash component in terms of investing? Whenever amount is parked in liquid, liquid is nothing but cash or cash equivalent. So we do have liquid as one of the asset class for in our portfolio. Is there any issues if investor goes abroad and NRI? No, there are absolutely no issues. We can accept the funds for NRI investors also in our strategy. Only thing is your status needs to be changed from a resident Indian to an NRI. For that, definitely we'll have to complete the documentation. But till the time status is changed, you will definitely stay invested. Once the status is changed, then automatically your portfolio will move from an Indian resident to an NRI resident. And there will not be any, I would say, miss in betweens. Our team will help you get through the documentation, including obtaining a PIS permission also for you. Once you become an NRI, you need an PIS permission for investing in India. And we have a well qualified, or I would say experienced team on our NRI side who will help you to complete all the documentation. So absolutely no issues either from Indian resident to an NRI or NRI to an Indian resident. Both ways it will be taken care by RI. Okay, with this, I feel there are no further or additional questions. Thank you everyone once again for your lovely participation. Okay, one last question has come, I'll take it. All other PMSs of demat account, why it is custodian account here? Mr. Ghosh, as per regulation, every portfolio managers are supposed to appoint a custodian. It is not that Prabhudas Lilladher doesn't want or wants. It is a custodian which is a mandatory requirement. And from investor perspective, believe me, custodian is an independent third party provider. So it will be much better. And it's not only me as a portfolio manager, as per SEBI regulation, needs to have a custodian. So that's the key reason. Are the returns redeemable? So I didn't get what does that question stands for. If you could just write a bit about it, because I'm not able to understand that. Are the returns redeemable? What does that mean? If you are talking about a withdrawal, yes. So in case if you give us a 50 lakhs and say end of a specific period, if your 50 lakh becomes say 58 lakhs and you would like to take off your profits or returns of 8 lakhs, you can definitely do so by just sending an email to us, and within 3 to 5 working days, we'll complete the partial redemption process and we'll credit your bank account. If that's what I understand correct, then yes, you can always take back the return to your bank account by just sending us a request on email, and there's one prescribed form. You just need to send the scanned copy of same and it will be done. Sure. Done. Questions? Okay, so I think so I've replied to that question. Any further questions? Thanks a lot, everyone, for your participation, and we really are looking forward for you as our investors. Me, Siddharth, we all are always available for any technical question that you would like to ask us. Please feel free to call us up or tell your advisor to set up a call with us. In case if you want to understand further in detail, we will be more than happy to get one-on-one. And I thank my entire team for such a lovely arrangements, and they have ensured a smooth session today. Thank you everyone once again from behalf of Prabhudas Lilladher, and we are looking forward for your participation and managing your wealth.